Unlock your potential with a comprehensive suite of investing tools and expert education with GammaEdge. Start your free 14-day trial today. Let's talk about charm. And it's going to be the same type of analysis, but it's going to be slightly influenced because you remember in the charm charts, the strike, although the OI surface is important here, this is due now to time. So as price starts stabilizing, these things are going to change. And let's make sure that we're all on the same page about how they're going to change. So charm is the measure of change in delta with respect to time. And what do we know about, and this is a quiz, and I want you guys to answer, what do we know about the delta for an out-of-the-money option, whether it's on the call side or the put side? What's as time marches on, what happens to these strikes in magnitude? Anybody? Don't be bashful.
Out-of-the-money options march towards zero for the deltas.
That's exactly right. So what's going to happen is that this out-of-the-money put is going to start decreasing effectively from its delta. When we look at the delta, as this starts decaying, it's going to get smaller and smaller and smaller. All right. So from a negative delta perspective, it's going to look like a positive going spike. And that's why charm is positive for a decaying out-of-the-money put. Same token here, since this is in the money, when we look at delta, and this is why I started with the delta charts, this is going to, since it's in the money, this is going to continue to grow more negative, which is why in the charm chart, you see it pointing down, right? So understanding where these charm strikes are and where the maximum sensitivity is really, really important. Because in your if-then statements, as we move across these prices, things are going to change. We're going to talk about this here in a second. The other thing I want you to realize too, and why we started with the delta chart, I want you to look over here in this area, and then I want you to look over here in the same area on the charm chart. Now remember, I plotted these with the exact same command on the axes. So the axis range is the same strike range for both of these. And you can see I've got a spike out here at 44.25, but when I look at the charm, there's very little there. And if I would have expanded the range a little bit further, you would see that it was flat. This is important to understand that when you have a deep in the money option or a deep out of the money option, charm collapses to zero. And that's because when you are already maximized out at a delta of 1, time can't make that delta go any further for an in-the-money option. And so what happens is that when you get a charm that is more sensitive in the middle across the spot price, as opposed to gamma, which we know is sensitive right at the spot price. So there's a sensitivity that manifests itself, and it goes to zero when you get far away on both sides. It peaks somewhere in the middle, and it's time dependent and a couple other things dependent. And it's positive over here and negative on this side, and the same thing over here on the put side. Why is all that important? Well, in the big picture of things, looking at the delta chart, there's going to be some areas that aren't going to contribute anymore. And so the dealer, you have to presume, is hedged for those areas. And we don't really care about those strikes. So price moving up and down sensitivity is where we care about. And even though there's a lot of delta, out in the wings, at least here, it's really irrelevant from a dealer perspective because they already took care of it. They already hedged it out. What we are looking at is the hedging impact here and here, as well as here and here, right? So we're most interested in, as time goes on, what is happening. Now, when gamma rears its head, it's because spot price has moved up and down, and this isn't a gamma chart, but it's going, when spot price moves to the left or moves to the right and possibly captures these values, that's when the charm really starts to build support. And Adit, this is where the other part of the conversation went yesterday. As we moved up past the 44.55, it set a new upside target. I think that was 44.80 or 44.90. And so yesterday we were looking at if we cross 44.80, and I know this isn't the chart from yesterday, but just pretend for a second that we're looking, say, at 44.25 here. I'm making this up, but you can imagine that as we approach that 44.80, which was the dominant strike, as we cross that, now we're pushing deltas and we're making those deltas positive. And even though it's on the put side of the equation, they're now reinforcing, and we've removed a major detractor of deltas in the overall model. And the same thing over here. What was out of the money on the call side would become in the money, and that too would be constructive. And that's why we said in the morning call yesterday morning above 44.55 potential fireworks, because we had those coincident strikes. And if we moved above that 44.55, we were taking a major series of strikes, and they were now going to be supportive to the upside. And indeed, I think they were for the most part yesterday. I haven't gone back and looked at the chart since we started talking here, but I think that was the case. So what does this portend for tomorrow? And then we'll wrap this up and we can talk about questions. This is basically saying that the 45.50 strike for tomorrow is obviously very, very sensitive. And it's the one that has coincided on both the put side over here and the call side over here. And if we take a look at, for instance, the net of these two, I think we'll see, so the 44.50 here and the 4,500. So this is telling us, for all intents and purposes, that if we can hold on to 4,500, we'll probably be bouncing more or less in this particular area. Now, let's do our if-thens. If we were to drop below 4,500, then this major charm strike then will be pointing down. And these will be out of the money calls, or they will become out of the money calls because of the domination that you see here. And they will decay throughout the day, where the in the money puts will start to take over. And again, we would have to go back to this chart and just see, if we fall down here, this becomes in the money, and then will be constructive in pointing down. So I think that's an important consideration to look at for tomorrow. The other one, of course, is that if we move up through the 45.50 tomorrow, and this is out of the money call dominated, now what we're going to do is we're going to force this in the money, and this could become a new floor for tomorrow if we were to push higher than the 45.50 by a significant amount and linger there for time, right? And that would cause the dealer response to have to hedge, and we would probably see that in the overall price movement. So that would be one way to interpret this, and we'll play it by ear. Now these charts will update in the morning, so they will have a different view once we get the OI updates. But the overall concept is consistent, and it's repeatable exactly as I described, and we just need to interpret and do our if-thens off of that. All right, so is that helpful? Did that clarify and put the visual on it?
Yes, absolutely. It's absolutely lovely. Thank you so much.
Yeah, my pleasure. I mean, to me, I think this is the heart of it, right? This is the heart of intraday zero DTE, understanding this, developing your if-thens based on this and what's in play. There is a nuance that I didn't talk about that I may have talked about yesterday. I like to talk about it. It's a little, it's cerebral in that we can't identify it exactly. John has been working on it. Our dev back-end ML guy has been working on it, but the challenge is he's getting ready to have a baby tomorrow, so he's not going to be working on this. He's going to be working on sleep and taking care of his wife here. So the takeaway of this is that this is an out of the money put, and we know that it's decaying from a negative value and becoming more positive relative to where it is right now throughout the day. That's why the charm is pointing up here. And you can see the impact of this is that as this gets smaller and smaller and smaller, this actually is going to decrease, although it's going to still be positive, it's decreasing and getting smaller and smaller and smaller throughout the day. But over here, the same strike on the call side, which we know is in the money, is going to be growing. And so there is, and the scales here are the same. The scale, we do this intentionally, so you can compare apples to apples here. And there's going to be a point where this strike, or this strike and this magnitude on the put side at this strike is going to be equivalent, the rate of change of delta of the calls is going to equal the rate of change of delta of the puts. This is when this tag will change states. And why that's important, it won't here, of course, because of the way this is currently structured. But you could see something become dominant midday. And we feel that transition is important because if you're trapped, for instance, in an in-the-money call situation, if you're above that, the chances of getting below that decrease rapidly once this becomes an in-the-money call. Why? Because charm, basically through the day, is going to continue to make this more and more supportive. And we get a lot of questions about, is this support or is this resistance? Well, it depends. We believe it depends on the moneyness, and we believe it depends on the state of either the left-hand plane, the right-hand plane, whether it's in the money call or in the money put. There is no question that at the end of the day, the out-of-the-money calls will have collapsed to zero, and the in-the-money puts will have maximized out at and limited out at delta 1. So there is a point in the day where this most likely will go to an in-the-money put status. And when that happens, if we're below it, getting above that level is going to be more difficult because as we march through time, we're beating up against a delta that is getting longer or shorter, more negative, tick, tick, tick as we go through the day. And it's just going to be harder, especially as if you remember, the theta curve is exponential. It's not a straight line. And it accelerates as we go into the close. So in about the last 75 minutes of the day, it's going to be really hard to break through these levels in either direction. Doesn't mean we can't. And remember what we said about deltas. Opening and closing of contracts will absolutely swamp what's going to happen with charm. But all things considered, the advanced 201 course here is that there's a point in time of the day where these flip states and they go in the money because the out of the money portion of it has collapsed and you're at parity. And what happens from that point forward, depending on where we are in moneyness, will probably pin us between those two levels. And we just, more often than not, we stay where we're between those two levels and bounce back and forth because there's no other place for us to go.